Ever since I started this channel 12 years ago, I've said many times that cash is not an investment. But with interest rates rising and bond prices suffering, is cash making a comeback? Hi and welcome back to the channel. My name is Pete Matthew and I'm a chartered financial planner based here in the UK. And we're in weird times for investors right now. Not unprecedented, I would argue, but weird times for sure. Pretty much always been able to get more of a return on your savings, that's savings in the bank as opposed to investments. You've been able to get more of a return on those savings if you're prepared to lock them up for a period of time. Generally, the longer you can lock up for, the better the interest rate that you get. But as I record this in December 2022, the best rates are available if you fix your deposit for 2 years. If you choose 3, 4 or 5 years, the rates are worse. Like I say, pretty weird. And this has led to some questions which I want to try and answer. So firstly, are bonds dead? Easy answer this, absolutely they are not. Now if you're holding a bond fund, chances are that it's suffered quite a bit this year. If it's very heavy in gilts, that's bonds with the UK government, well, if that's the case, you will probably have really taken a beating in 2022. And many folks are asking, is it likely that bonds will recover at all? How long will it take? If so, should I just cut my losses and go into cash or something else? Well, no one knows how long bonds will take to come back to the values that they were enjoying a year or so ago. But I don't think anybody really believes that as an asset class they are dead and buried. Really, that's just unthinkable. Remember also that bonds are primarily about the income that they produce, and that's why we tend to talk about bond yields, which is the income that they produce as a function of the price that you pay for them. So, simple example, if you pay £100 for a bond and it produces £5 a year in income, that's a yield of 5%. But if the price of the bond falls to £50, then the £5 income, which is fixed, remember, well, that's now 10% of the price that you paid. Now, recently, yields have been rising, and that means that prices have fallen, and that's why investors in bonds have seen the values of their portfolio fall. But if yields are now high, then for those investors who are looking for income, bonds are more attractive. How attractive, though, depends on all kinds of factors, but interest rates is a key one. If an investor can get a better interest rate with their money safe in the bank, why would they take a risk on bonds? When interest rates come down, and they probably will, but likely not for a while, then bonds will look more attractive than they do now. So bonds are not dead, they're just a bit depressed, and they're probably going to stay that way for a little while. So should you sell and move into cash? Well, again, I'd argue not. If you're investing for a long time, then the chances are that the proportion of bonds in your portfolio, compared with equities, say, is pretty low. So you do have the chance to let them recover and let the growth assets, the equities, do the heavy lifting for a while. If you're a cautious investor, or if you're retired and you're not wanting to take the risk that you once did, then I can absolutely understand the temptation to cut your losses and sell to cash. But really, the damage in bond prices is already done, so to sell out now would be locking in that loss. Of course, it could get worse before it gets better, but I really can't see the benefit of just crystallizing a loss. Losses, remember, are never permanent unless you realize them, unless you sell the assets that have gone down in value. Cash is more attractive now than it was, but interest rates are still much lower than the rate of inflation, and that's likely to always be the case, except for occasional and relatively short periods of time. Quick reminder here that if you haven't already, please do hit the like button and subscribe to the channel, because it keeps the video and the channel near the top of the weird YouTube algorithm's robotic mind. So thank you in advance for doing that. So we've learned that inflation and interest rates are clearly big factors in bond prices and how attractive bonds are. So what might happen going forward? Again, I'm talking to you in December 2022. Well, most things that I read suggest that interest rates will rise further in December, maybe by another 0.5%, which would take the rate to 3.5%. I'm also seeing that rates will peak in the first quarter of next year, probably to around 4.25%, but that's less than was thought likely just a few months ago. Inflation is widely expected to fall next year, perhaps down to about 4%-ish maybe by the end of 2023. The Bank of England won't rush to bring rates down though, so they'll have a bit of a balancing act to do. I've seen projections that have interest rates falling back to 2.5% by the end of 2024, 2 years from now. but other projections that say rates will still be over 4.5% by then, so nobody really knows. But I think the fact that banks are offering lower rates on their 3 to 5 year fixed term deposits than they are on their 1 and 2 year deposits suggests that they think rates might fall sooner rather than later. But one thing is for sure, we are not heading for interest rates like we've enjoyed since 2008 anytime soon. So, what should you do? Well, you should always be invested for the long term anyway, and if we're talking about like 2024 and 2025, that's still a very short time away in investment terms. If you've got cash to invest right now, personally I would just stick to whatever your normal allocation might be. You'd be buying bonds at low prices and equities even that are still some way off their highs. Don't hold loads of cash, even if you can get what seems like good interest rates right now, because those rates are still losing you money once inflation has been taken into account. And until that changes, then cash is still not an investment. You could hold slightly more cash as a safety net while things are still volatile, but I wouldn't hold off investing completely because you just might miss out on some decent growth in the next few months and years. So I guess what I'm saying is, as you were, don't change what you've been doing because of what's going on right now, because right now is utterly irrelevant in the context of a multiple decade investing career. So why even worry about what's going on right now? Cash feels safe. It seems as if it's a kind of defensive option. But whereas real assets like bonds and equities and property have the chance of beating inflation over the longer term, cash does not. It will lose you money in real terms. So don't let the fact that interest rates are better than they were sucker you into believing any different. Let me know what you think in the comments. As ever, thank you so much for watching, and I'll see you in the next video.